It's time for Yahoo Finance's Market Minute. Stocks are higher for the third day in a row as investors navigate rapidly changing trade policy. The EU saying it expects most tariffs to remain as negotiations make little progress. Stocks paring their gains off of that headline, but we did get more bank earnings. Citi and Bank of America both rising after topping Wall Street's expectations in their latest quarters. The banks reporting increased revenue fueled by booming in trade volume amid the market volatility. Johnson & Johnson shares lower after topping earnings estimates and boosting full-year sales forecast. Meantime, the Trump administration is probing pharmaceutical imports, setting the stage for tariffs on the sector. And Boeing shares are lower as China tells airlines to halt orders of the aerospace giant's jets in the latest escalation of the U.S.-China trade war. That's according to reporting from Bloomberg. And that is your Yahoo Finance Market Minute. For more on what's trending, scan the QR code where you can track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we talk to one chief investment officer who shares 5 investor recommendations amid the tariff-fueled uncertainty. And, oh my God, it's tax day. If you haven't filed or know how you can pay, well, guess what? We've got you covered with some last-minute tax tips. Plus, all week on Wealth, we'll dive into the class of 2025's financial playbook. Whether you're a new grad or a parent of one, we'll break down the basics you need to build a strong financial foundation. Today's focus, workplace benefits. You don't want to miss that. We've got all that and much more coming up during this hour. But first, let's kick things off as we always do. Taking a look at some of the market action. We are 90 minutes into the trading day. Stocks in the green for a third day as investors digest bank earnings and tariff-fueled volatility eases a bit. Joining me now for more, we've got Brad Roth, THOR Financial Technologies Chief Investment Officer. Brad, good to have you here on the show with us. You have a few recommendations for investors as we continue to see some of the tariff-fueled uncertainty permeate. Walk us through those recommendations.
Sure, and Brad, thanks for having me. Look, I think if you haven't already, now's a great time to have some liquidity in your portfolio and be able to look at some opportunities that might be arising out of all this uncertainty. Secondly, there's a lot of new products out there, such as low volatility ETFs, some defined outcome products, some buffers that you might be able to add to your portfolio. And look, I think now's the time we really want to focus on quality. I was watching the show earlier. There's a lot of quality names out there that, as an investor, you should really be looking at. Banks, as we know, do well in volatility as well when we have higher rates, as the 10-year has moved up quite significantly. We also think you need to be positioning your portfolio to look at some of the things domestically that should do well in some of these positions, like a Johnson & Johnson or a Walmart or a Pepsi or a Coca-Cola, some of those more traditional defensive names.
Some of that uncertainty as well is just trying to think through what might get said or might not get said this earnings season. And why I say might not get said is because of the earnings and the guidance specifically, as companies are painting the picture for their forecasts amid some of the broader policy clarity that they're awaiting as well. What are your anticipations there?
Yeah, you know what? I am less worried about earnings, more worried about guidance. It's what could or may be said. And I think guidance, executives are probably going to use all of this tariff talk, volatility, and uncertainty to maybe potentially lower expectations for the future. And so as we look at first quarter earnings, as we go through this earnings season, it's all eyes on guidance. I think we should have a strong earnings season in terms of the numbers, but it's that guidance that we're all really looking at as we listen to a lot of the larger companies, like the Mag 7s that everybody has invested in for so long. What's Apple going to say, right? What's Microsoft going to say? What's Alphabet, Meta? What are all these companies going to say? And that to us is a lot more important than maybe the numbers that they're going to show this quarter.
Okay, so with that in mind, as you're thinking about sectors that you're touching and those that you're staying far, far away from right now, where are you looking?
So we think you can be selective in tech. Some of the domestics like Apple and Microsoft were still okay. The tariff uncertainty that you have in semiconductors makes us a little bit weary in Nvidia, largely. We do like financials here, volatility. Like I said earlier, they do very well. So we saw great earnings from Goldman Sachs. We like JP Morgan. We like asset managers like BlackRock. We also like healthcare. You got names like Pfizer and Johnson & Johnson, and consumer staples, like I mentioned earlier. If you have those Walmarts, the Pepsis, the Coca-Colas, we like those somewhat defensive sectors. Although we do have tech as a recommendation, we want you to be fairly selective inside that tech sleeve.
And so with that in mind, as you're thinking about some of the areas that are your recommendations for investors as a general checklist, even as you're kind of navigating through this environment now, what is the kind of best decision tree that you're recommending to some of your clients, especially as they're going about their stock picking and trying to pick companies that are going to outperform based on, well, the broader pullback that we have seen at this juncture?
Sure. Well, I think, look, anytime you're making investment decisions, you need to be following some sort of rules-based process. Anytime you start to get volatility, investors make the number one mistake that they always make, which is they get emotional. They might change their strategy. They might, run away from things that could work and maybe sit on cash for too long. In these instances, really try to get laser focused on creating a process. Maybe if you're really scared of volatility or drawdowns, put some stop losses in place. But that decision tree really needs to be emotionless. Follow a strategy, stick to it, and try not to make snap judgment decisions. Especially as we've seen over the last couple of weeks with this volatility, you have massive down days, and then all of a sudden you've got a 10.5% up day in the S&P 500 out of over a tweet, right? And a change in policy. So just stick to a plan and try to stay as unemotional as possible.
Yeah, a lot to keep tabs on. Brad, thanks so much.
Thank you, Brad.
Now time for some of today's trending tickers. We're watching Albertsons, General Motors, and American Airlines. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal to help break them all down. First up, Albertsons is falling after forecasting lower than expected earnings for the year. The grocer sees adjusted earnings per share of $2.03 to $2.16 versus the estimate of $2.29 here. We're continuing to watch shares of Albertsons here this morning, and this a big report because it kind of gives us a pulse of the consumer in those grocery aisles.
Yeah, and really an indication that the trade-induced guidance hits, they're starting to trickle in, which we expect and likely will continue to see throughout this earnings season. And Albertsons is in an interesting position because they're not totally affected that much by the import tariffs on China, Canada, Mexico. However, it's that inflationary ripple effect that will happen from the trade war that's really weighing on this company, particularly when we think about the consumer. On the earnings call, management called out the customers' need for value. They described 2025 as an investment year, so they're going to be remodeling stores. They're going to be offering lower prices, select discounts, investing in its loyalty program. And the hope is that all of these efforts can really offset any spending slowdown from inflation. Now, that being said, the competition is very intense. Evercore ISI was out with a note that said Walmart, Costco, they're all making significant inroads with that lower income consumer. So it's really finding a way to get to that customer base, especially during these uncertain times.
Absolutely. We're also tracking General Motors here too, downgraded at Barclays to equal weight from overweight, also reducing the price target to $40 from $70. That's about 11% downside from the stock's last close, and the firm also cutting its view on the U.S. auto industry to negative. Shares of GM right now, they are lower by about 1.7% out.
I mean, the auto industry, they just can't catch a break, man. I mean, we had the Detroit auto strike not that long ago. Now we have all these tariff uncertainties. And it's for a company like GM, it's important because nearly half of the vehicles it sells in the U.S. are actually manufactured outside of the U.S. And then when you think about their EV fleet, that's their more affordable option. Most of those are made in Mexico, so they might not even be able to hit those EV targets. And we know that the EV space in general has been really pressured for all of these car manufacturers. So just a lot of risks amid these tariff uncertainties. Barclays saying that valuations are seemingly not pricing in the full tariff risk. And if we take a look at where shares are trading right now, we're off of the lows of the 52-week highs, but we're still down about 8%. Over the 5-day period, we are up about 4%, and that's on the heels of Trump saying that he's looking for something to help some of these car companies. But until we hear anything more about that, there's not a lot of near-term catalysts here for a company like GM and a lot of these other automakers as well.
Yeah, and with that in mind, Wedbush's Dan Ives telling Yahoo Finance this morning that he actually believes that Tesla is better positioned versus GM, Ford, and some of the foreign automakers, believing a tariff should be finished on autos versus parts, or on finished autos versus parts there. We'll see exactly what's the details, as many of these tariffs, what the details are.
Everything hinges on the details, Brad.
Does, and we're running scarce on those right now. Finally, American Airlines, in partnership with AT&T, will offer complimentary in-flight Wi-Fi across more than 2 million American flights a year, beginning January 2026. Shares of AAL, you're seeing them popping on this news. They're up by about 3%. Who doesn't want more connectivity in the sky?
I mean, finally, they were the last of the big three airliners to offer this Wi-Fi. And personally, for me, with how expensive flights are, I sometimes look for the airline that I know guaranteed offers Wi-Fi. JetBlue is one of my favorite airlines because of that. I'm a busy gal. I got to work. I got things to do. And if you're not offering me Wi-Fi, I'm not paying 15 or 20 bucks to, access that for 30 minutes. So this is, I think, a given that all of these airlines should really be leaning into. This is an important one for me. I'm very passionate about it.
Well, let me tell you this. Naps on flights are free.
That's true. I'm not a napper.
Wow. All right. We could. We'll take that to a
I'll
different
fly with
conversation.
you next time, and you give me the tips and tricks to nap.
Look, that's easy for me. I got you covered. Thanks so much, Allie.
Of course.
You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up on the other side of this short break, we've got much more on wealth, including how tech stocks are down so far this year. But is this cause for concern or an opportunity to buy in? I speak to a portfolio manager about navigating tech and net investment thesis next on Wealth. Tech stocks have been under pressure. All of the Magnificent Seven are negative so far this year, taking the brunt of the beating in the market as President Trump's trade policies rattle investors after 2 years of massive gains. Is this an opportunity for investors or a cause for concern? Joining me now, we've got John Belton. He's a portfolio manager at Gabelli Funds. John, good to see you. So what do investors need to know about the volatility in the tech sector that we've seen transpire to this point through the first quarter of the year?
Yeah, good to see you. So, I think that the starting point I'd begin with is every Mag 7 stock is lagging the S&P 500 year to date, which is sort of an interesting stat. So the Mag 7 has become the Lag 7 this year. I think a lot of the pain or the sell-off in a lot of these names started before a lot of the tariff concerns. There was a tech-specific negative catalyst earlier in the year when the Chinese AI model company DeepSeek released their new model, and we all know how that turned out for the sector. But a lot of these stocks have experienced a lot of pain so far. I think from here, I'm trying to stay focused on the long term. If we're talking about AI, I think a lot of the long-term fundamentals there remain very much intact. In fact, I think a lot of the recent news flow we've heard in that space has been quite positive. So I do think the fundamentals for these companies remain generally strong. And so, yeah, there's definitely some opportunities out there that are starting to emerge.
Okay, and so help us qualify what is a sound tech trade right now versus a weaker tech trade.
Well, I think so. If we're sticking with the Magnificent Seven, I think the mechanical impact of tariffs, given everything we know today, that's been priced in. I think what hasn't necessarily been priced in, or what we're really focused on now, is how does all this uncertainty around trade policy impact the macroeconomic outlook? How does it impact the consumer, and how does it impact business capital spending plans? And so I think across the Mag 7, there's a big range in how cyclical some of these business models are. So on one end, you have the digital advertising companies, Meta, Google, and their peers, quite cyclical businesses, at least relative to the other Mag 7. On the other, you have some of the enterprise software companies like Microsoft, much less cyclical, much more defensive business model. So I think that's sort of the next leg of this trade, or the next leg of this market cycle, is trying to figure out what is the macroeconomic outlook? Are we going into recession? How durable have these fundamentals that we've seen until now? How durable are those going forward?
Okay, and so what's the mix of technology in your portfolio when you are kind of enacting a defensive strategy because of a certain threshold of uncertainty that we've clearly seen struck within the markets at this juncture of the year?
So it depends on what exactly you consider technology, because our Meta and Alphabet are those media companies, or are those technology companies? But I think if we take technology into kind of the subsectors, we're starting to get a little bit more constructive on a subsector like software, as an example. Particularly some of the more defensive areas within software, like back office software, stuff that's harder to rip out. So I think that's a much more defensive area of tech. Semiconductors, I think there's a range there. There's cyclical, sort of more analog semiconductors, where I think more cautious there. But some of the AI semis, again, some of these stocks have taken a lot of pain year to date, and I think a lot of the fundamentals there remain pretty strong. So we're cautiously optimistic on some of those names, and we're sticking with those despite what's been a challenging year so far.
Go ahead. Sorry. I'll allow you to finish real quick.
No, I was just going to say, then outside of semis and software, you have a whole other range. You have e-commerce being another vertical within tech, and I think that's also a more cyclical subsector. But within that space, we do still like Amazon as an example.
Okay, so within that, I guess what you're starting to get at too here is the difference between some of the core business-to-business technology names that typically promote some higher margins, that sell into their existing portfolio base, and then also look to gain net new customers and subscribers, either on a license basis or on just kind of a block purchase basis, versus those that are more business to consumer, that rely on their advertising sales to really kind of buoy their own margin model as well. As you're kind of looking across those two differing sides of technology, and of course some of them like Amazon and Microsoft overlap, where is there more strength from your own evaluation?
Right. So the question is kind of looking at consumer tech versus B2B tech, where what do we like more right now? I think this is maybe a cop-out answer, but it is a little hard to generalize there. But I think we would generally gravitate towards more B2B type platforms in the current environment. But within that, I think you have to figure out which areas are going to be the first to be pulled back if IT spending pulls back, and versus which are the more the harder to rip out solutions that are being provided. So I think very defensive kind of back office software, a company like Intuit, we still really like in this environment. We like some of those ideas, versus just using as an example, we don't own Salesforce, but Salesforce we think would be a little bit more prone to IT spend pulling back in this environment. So I think it's hard to generalize, and then just as to tie the bow there. I mean, I think one thing we're hearing very consistently from IT executives and from different channel checks that we do before earnings, again, AI remains very, very high priority. I think companies are very reluctant to pull back spend on AI solutions. So I think doesn't really fit either of these buckets that we've been talking about cleanly, but I think it's an area that, for various reasons, is very high priority. It's going to be harder for companies to pull back a lot of that spend.
Yeah, interesting analysis. John, thanks so much for taking the time having the conversation with us.
Thank you.
Coming up, it's tax day. Your final chance to submit your taxes from 2024. But if you haven't done it, or no you can't, don't worry. We've got you covered with the last minute tax tips you need to avoid penalties. Stay tuned. Welcome back, everyone. Let's get a quick check of the markets here as we're taking a look at the Dow Jones Industrial Average. Somebody is doing some serious charting on here. We're just going to kind of try and take those off. As of right now, you're taking a look at the Dow. Right now, it's higher by about 0.2% here on the day. Also, you've got the NASDAQ Composite. That's higher by about 0.3% on the day. This is on a year-to-date scale. Let me put this on intraday. Perhaps we'll get rid of some of those lines for you. And magically, there it does. S&P 500, you're seeing that higher by about 0.3% on the day. So some fractional moves higher across the board here on this tax day, which we'll get to in just a moment. I do want to dive in, though, to some of the sector activity that we're seeing transpire here just about 2 hours into the trading day. We're taking a look at largely gains across the board, led by financials. Of course, we had some more of the big banks reporting this morning. Of course, Citigroup, Bank of America taking center stage here. And then additionally here, pulling up the caboose, you've got one in XLV in healthcare. That's down right now, but it has touched the positive side of the trade as well during the day, we should note. And then additionally, consumer staples, which that too has been kind of in hyper oscillation over the course of today's activity, waffling between gains and losses here. We'll see where that continues to settle as we get into the rest of today's trading activity. But just three laggards and the majority of gainers here. Let's check in on technology. Right now, taking a look at the NASDAQ 100, you're seeing things among the Mag 7 names kind of split. Apple, Alphabet, Amazon, and Meta, they're in negative territory. However, you've got Tesla, Nvidia, and Microsoft all holding on to some gains as of right now. You've got some solid green here on Palantir. I know that's one of the heavier tracked names on the Yahoo Finance platform. That one is up by about 4.7% here on the day. Netflix, that too, another name that you're going to be watching for reporting earnings soon. That is higher here right about now by about 5%. So we'll continue to track all those names as we move on throughout the rest of today's trading session. It is tax day in the United States. April 15th marks the deadline for individuals to file their federal income taxes with the IRS. It's also the deadline for many state returns, although there are some exceptions. Joining us now to discuss some last-minute tax tips, we've got Andrew Gordon, partner at Gordon Law. Andrew, as of April 4th, the IRS has received more than 101 million returns. That's actually down 0.4% from last year. So what do Americans who can't file today need to know about getting an extension?
Yeah, Brad, filing tax returns getting more difficult as more tax forms are being issued. More and more people don't have what they need in order to file on tax deadline. So today is April 15th. It's tax day. If you haven't filed yet, you better get busy. But one other option is to file an extension. Filing an extension will give you an additional 6 months to file your tax return. And that's important because there are two big penalties to be aware of. And that's the failure to file and then the failure to pay penalty. By filing an extension, you'll get an extra 6 months to file, but it is not an extension to pay. And what this means is that your payment is still due today. It's due April 15th. And if you pay later, interest and a late payment penalty of 0.5% per month will begin to accrue. So how do you avoid this penalty? The easiest way is to make an estimate of what you owe today with your extension. And that way, penalties and interest will stop accruing.
And so what if you can't pay your taxes? Because even though, as you were breaking down, an extension to file is not an extension to pay, but there are some people that really just can't afford the figure and may be getting caught off guard when they're getting ready to file.
Yeah, so Brett, first of all, the most important thing to do is still file that extension or still file your tax return, even if you can't pay. But if you can't pay, believe it or not, the IRS will work with you. They will allow you to enter into a payment plan. And we've helped clients have even 10 years to pay their IRS balance. And while you're in a payment plan, the penalties are even reduced. So it's a great way to have a monthly payment that you can pay towards that balance and not be in IRS collections, which is never a good place to be. But another thing to be aware of is that although the IRS gives taxpayers the option to use a credit card to pay your taxes, in many cases, this also is not a good idea. You'll be accruing a very high interest rate, and you'll be better off in many situations just reaching out to the IRS and working out a payment plan directly with them.
So what are some common filing errors that you're coming across this tax season?
So these are some mistakes that not only I see in practice all the time, but the IRS has also said these are very common and have impacted people in receiving late refunds, but also substantial penalties. So today is the tax deadline, and if you're rushing to get everything completed, another reason to file an extension is because as you're rushing, you may make some big mistakes. And one of the most common yet simple ones is failing to sign your tax return. You might think, who forgets this? But many, many people every year fail to sign and date their tax return. And as a result, their refunds can be delayed or even get penalties later on. Another big mistake is the wrong filing status. In the US, we've got married filing jointly, married filing separately, head of household, single. It takes an accountant to know all these rules and understand what fits best for you in many situations. However, a lot of people filing on their own choose the wrong status, and this leads to sometimes audits and large penalties, not to mention getting their refunds late. Another big one to be aware of today, tax deadline, is writing down your correct bank account information. Again, sounds very simple, but one digit that's incorrect can lead to months or even years of delay in getting your refunds.
Wow. Okay. So we also want to get people prepped for the next tax season. We're experiencing some market uncertainty of late. The major averages all in the red over the last month of trading. What is something that you can do in a down market to help you lower your tax bill for next year?
So one of the best strategies in a down market, and I get it, you're in a down market, you're often not thinking about selling, but one of the best strategies is called tax loss harvesting. And this means that you sell to realize your losses so that you can use those losses to offset future gains or future income, either in the current year or it can be carried forward year over year. Now, these gains can offset stocks that you sell in the current year that are completely different stocks. But also, another option is to buy back that a similar stock within 30 days. If you wait 30 days, you could then still buy the same stock. It's called the wash sale rule. But if you harvest that loss and buy a similar stock within 30 days, that's also all right. So for example, maybe sell SPY and then buy VOO. And so by doing this, you're able to realize that loss. You get that loss on the books that can then reduce other gains, but you're also maintaining your position. Now, of course, you should talk to your accountant and consider your investment goals, because by doing this, you are resetting your holding period. So there's not only benefits, there are some downsides to harvesting your losses. But in many cases, it's a great way to reduce your current year or future gains.
Andrew, always a pleasure to speak with you. I know that this is the big day for you. It all comes down to this, and I imagine that there's a nice vacation on the other side of all of the filing that you're working through. Appreciate it.
Thank you, Brad.
Thanks. Coming up, why this weekend might be the best time to sell your home this year. That's next on Wealth. All the ingredients in the mix for a busy spring home buying season are there. Buyers seeing more inventory, mortgage rates steady, and mortgage applications picking up. But then President Trump announced sweeping tariffs, spreading volatility across markets and pushing consumer confidence lower. So, have tariffs changed the trajectory of the spring home buying season? Here with more, we've got senior housing reporter Claire Boston. Claire, what are we seeing during this time of the year? It's supposed to be the most magical time of the year.
Right. This is like peak spring home buying season. The name of the game I am hearing right now is uncertainty. If you are a buyer or a seller and you don't know what's going to happen with these tariffs, you're worried about a recession, that is causing some people to just rethink those home buying plans, according to people that I've been talking to. That doesn't mean that people are out of the market altogether, but maybe you're looking for a little bit of a smaller home than you thought if you're worried about losing your job. And maybe you don't want to put in that offer on a home now if you think that prices could drop, say 5% in the coming months. And so it's really kind of complicating what we thought was going to be a pretty busy spring. Mid-April still fairly early days for the housing market, so we'll have to see how this goes in the coming weeks.
What do we know about home prices during previous market corrections as kind of an analog or comparison?
Yeah, so what's really interesting is that historically during these stock market corrections, home prices actually usually continue to go up. There is one exception, that was 2008. That was a financial crisis that was caused largely by the housing market. But generally speaking, home prices don't fall. What does fall is sales, and that kind of makes sense. If you see that uncertainty, maybe you don't want to buy, but they usually pick up pretty fast once stocks kind of return to normal.
Claire, we also got some information today, some new data from Fannie Mae showing expectations for home price growth to actually moderate. What do we know there?
Yeah, so Fannie Mae runs a quarterly survey of housing experts. And so this is the first quarter survey. It looks at March, which was before these tariffs. They are now expecting home price appreciation of 3.4% in 2025 and 3.36% in 2026. That is down slightly from last quarter, where they were expecting 3.8% in 2025. And so, again, it remains to be seen how tariffs are affecting things here. But, I think this kind of reflects some of the weakness that we're seeing in parts of the housing market. We've talked on the show about Florida and Texas, and just a little bit of, that consumer uncertainty right now.
Claire, excellent breakdown. A lot to continue to track. I know you got a couple Zillow tabs opened or something.
Always.
Always, yes. Thanks so much.
Thank you.
According to Realtor.com, this week, April 14th through the 19th, is the best time to sell your home in 2025. Here with the details, we've got Hannah Jones, Realtor.com Senior Economic Research Analyst. Hannah, good to have you on the program with us. You released this research in March, which, with everything that's happened since, is it still true?
Yeah, so this week does still bring the best combination of housing conditions within the year for sellers. However, of course, recent events have introduced some risk to that forecast. But nevertheless, the spring is a time when buyer demand is on the way up, prices tend to be on the way up, but sellers have not quite flooded into the market yet. And so those early sellers stand to see a market ready for well-priced move-in ready homes.
And so with that, mortgage rates were at 6.6% for the past 2 weeks. Based on Realtor.com forecasts, is that the best level buyers can hope for this year?
Uncertainty is the name of the game. It's unclear which way mortgage rates are going to go. It looks like they might go a little bit higher in the short run. But generally, working with an expert, working with a realtor, and having an honest conversation about, what price point am I able to afford given rates, given how much savings I have, and given what's on the market. That's the most important thing to be looking at for buyers right now.
Why is this the 7-day stretch that is the best week to sell your home and to list your home and put it on the market and hopefully woo some potential buyers out there?
Yeah, so we look at a variety of different factors, but it's really the combination of, prices are, above the year's average. They're above earlier in the year. Buyers are coming back in the market faster than sellers are generally. And, you're not seeing as many price reductions, and you're not seeing as many price reductions, and you're able to continue to get buyer demand, especially, in this market, which is still really challenging for many buyers. Buyers are excited to see, move-in ready homes. You've done those little updates, you've painted, those sorts of things are really going to be what grab buyer attention.
Okay, so you started to answer the question, but what more should sellers be doing if they want to take advantage of the buyers that are out there, of course, making their list, checking it twice, and trying to figure out which house is right?
Yeah, absolutely. So, this housing market, like I said, is very challenging. And so sellers should really price competitively, be realistic, price competitively, and you will see, or you could see that you get multiple offers, that you get a lot of buyer attention if you do price at a point that is attractive to buyers, especially, if your home is looking good, it's showing ready, all of that. Those are great ways to entice buyers to look at your home, because buyers are feeling really strained in this market. Okay,
so from the buyer's perspective, how can they best approach the table here? Is now a bad time to buy?
It's not necessarily, there's no bad time to buy. It really depends on what you need, where you are in your life. Life does go on, marriage, divorce, kids, those sorts of things. And so I think what buyers can do to really prepare for this market is, have a real conversation with an expert, such as a realtor, to understand, how much do I have? How much will it take to get what I want, where I want? And, will I need to make any concessions? Are there any things, maybe looking at a smaller house like Claire was discussing, or maybe looking in a different neighborhood that's a little bit lower priced, having those honest conversations, and then, really getting your ducks in a row, because there are some markets where homes are still selling really fast. So that means that, you need to be ready to move once you see what you're looking for on the market.
Should you be down? Should you be discouraged if you don't sell this week?
Absolutely not. This is the best week to sell, but the next few weeks are nearly as good. The risk that you run getting deeper into the spring and the summer is that more sellers come onto the market, which means that you're going to be facing more competition from other sellers. And you'll see, a higher likelihood of price reductions, a little bit less demand for your property. And so, just getting in on the early side is a great idea, but you also shouldn't sacrifice, those necessary things to get your home ready for sale. So it is a balance. You want to make sure your home is ready for showings, ready to be seen, and, try and get into the market perhaps before, the chaos of the summer.
What do you think the uncertainties are between next year's big selling season and this week, this power week that's playing out, that we've typically looked to kind of be the major catalyst for the seller's market within the April 13th through 19th range?
Yeah, there is a lot of uncertainty right now, and buyers are feeling it, sellers are feeling it. It's a little bit of a scary time to be making big financial decisions. And so I think that just how the tariffs play out, how different economic policies play out, are going to really impact, seller and buyer sentiment, depending on how secure people are feeling in their jobs, how much they feel like they're able to save or spend on a down payment right now. Those are going to be really important factors as we get deeper into the selling season.
Hannah, thanks so much for breaking this all down for us. Appreciate it.
Yeah, absolutely. Thank you.
Coming up, we have your 2025 Graduate Playbook. Today, we'll tell you everything that you need to know about enrolling in workplace benefits for the first time. That's next on Wealth. As part of our theme week, the class of 2025's financial playbook, we're talking all things retirement today. A recent Northwestern Mutual survey found the average American believes they'll need $1.26 million to retire. And time, it makes a huge difference. A 20-year-old saving just $330 a month can reach that number by retirement age, compared to a 50-year-old who would need to save almost $4,000 each month. With the help of workplace plans, you can start early and stay consistent, and those savings will add up. Joining me now to discuss, we've got Ann Lester. She is a retirement expert, speaker, and author of the book, Your Best Financial Life. Save smart now for the future that you want. Ann, great to have you here in studio with us.
Thank you so much for having me.
So what are the different types of accounts that an employer may offer, and which one is best for new graduates?
So workplace plans, let's call them that, right? Defined contribution plans is what most employers offer, mean that you contribute something that you define, so that's your contribution. Most corporate employers will offer a 401k plan. Those come in two flavors, regular 401k and Roth 401k. Now the big difference between those two is that a regular 401k plan, you contribute after you pay taxes. So, you contribute before you pay taxes. So the money that you're contributing to a regular 401k is not money you pay income tax on. So it sounds like a great deal, right? But if you're a new grad, you are probably going to be at the lowest income level you'll ever have in your life, and their lowest tax rate that you'll ever have in your life. So if you're starting out at $40,000-$50,000, you're probably not going to pay much in taxes anyway. So for a lot of people who are starting out, doing a Roth 401k makes a lot more sense if your employer offers. That way you pay taxes on what you contribute, but then it grows tax-free, and when you retire, you take it out tax-free when you're much more likely to be in a higher income tax bracket. So a Roth, most employers offer those now, and those are a great choice if you've got that, if you're young.
So what is an employer match, and how do you know that you're maximizing one?
So employers in 401k plans and in some other plans, there's a whole alphabet soup. There's 403bs, which are government and education, not-for-profits offer those, but they basically all work the same way. Most employers will match what you put in, usually at a 50% rate. That's a very common rate. So if you put in, let's say, 5%, your employer will match half of that, or 2.5%.
Okay.
Many employers stop the match at 6%. Others will go all the way to 10%. So you've got to read the rules, but typically you get a match on at least the first 6% that you contribute. So the way to think about the match is free money.
Yeah, well,
you want the free money. You want to get all the free money.
Yeah.
And if you're worried about investing now and the markets seem a little crazy, just remember that when your company matches what you put in, you're instantly getting a 50% return. That is like the best return you will ever get on your investments, right there.
So there's one very important word to know with any type of company dispersal that's taking place, and that's the vesting cycle, the vesting period. What do you need to know about vesting in a retirement plan?
So most companies do something called vesting. Some don't, but most do. And that means that they'll start making contributions to your contributions, right? They'll be adding, they'll be matching, but they won't necessarily give it to you if you don't stay there for a certain period of time, and that's the vest. So some companies it's 6 months, some companies it's 3 years, some companies it's 5 years. That's another place you want to pay attention to the details. Because if you leave your company's employment, typically voluntarily, you don't typically keep that match while you're still in that vesting period. So if you're thinking about changing jobs, again, something new grads do a lot, you want to look at that vesting schedule, because if you're only a month or two away from hitting that number, you might want to time your departure to match with that vesting date so you get that free money.
Let's talk allocation here. What is a target date fund and how does that work?
So I used to manage target date funds, I'm just saying. So I love this whole topic. Tell me if I go long here. A target date fund is what the name says. It's a fund that matches your target date of retirement. So if you're just starting out today in 2025, you're probably going to retire in 40 or 45 years. So you would want to be investing in the 2065 or kind of mind-blowing 2070 fund. I know, like that's a long way away. This is why they're so great, because you don't have to think about it. You put your money in there, and the person managing it, who's a fiduciary, is going to automatically rebalance your portfolio and change that allocation over time. So today it might be mostly in stocks. When you get to 2060 or 2070, it's going to be a lot more in fixed income and safer, more conservative investments. And the beauty of it is you don't have to think about it, especially when you have to make so many decisions when you're just starting out.
And really great breakdown. Really appreciate the time.
No, thank you.
An employer retirement plan is the perfect way to start saving decades in advance, but what if your employer doesn't offer one, or if you're self-employed? Don't worry, you've got plenty of options. Senior columnist Carrie Hannon, she joins us now to break them down. Carrie, let's start with IRAs and Roth IRAs. What is the difference and how can you use them to save?
Yeah, absolutely. Now is the time to start thinking about 2025 taxes, right? Because most people don't take the time to start automatically setting aside for next year. But if you can, try to do that. The first way, as you mentioned, the individual retirement account, is where you can set aside pre-tax money into this account, an individual retirement account, up to for next year as well as it was for this year. It's $7,000 unless you're 50 or older, and you can throw in an extra $1,000. The Roth IRA is you don't get that upfront tax deduction, but when you take that money out at retirement, if you follow all the rules and income limits, you take that out, you don't pay tax on that or on the gains of it. So that's a really sweet thing if you don't need the tax deduction right now.
So what about a simplified employee pension plan?
Yeah, that is really, if you're self-employed, it's a great way to actually set quite a bit more aside for retirement than that limit for the individual retirement account. You can get up to 25% of your compensation you can put aside in a SEP. And so when I was freelancing and ran my own business, that's what I had. That's a great way to give yourself a little more oomph in your savings.
And then lastly, while we have you here, there is something called a solo 401k. Okay, so break this one down for us.
Yeah, I think they're fantastic. I think if you have the opportunity, you have to have this set up by the end of the year, of the tax year, so by December. And this gives you even more flexibility to set money aside because you're making contributions to this plan as an employer and as the employee. So it gives you even more flexibility than you had with the SEP retirement plan for self-employed. So I encourage people to look into it, talk to perhaps your tax consultant about it, but a solo 401k can give you a lot more flexibility and a lot more savings.
Carrie, thanks so much. Great breakdown. Really appreciate it. Let's do a final check of the markets as we're taking a look at the major averages right now. The Dow Jones Industrial Average, you're seeing that higher by about 0.2%. Fractional gains also seen in the S&P 500. That's up 0.4%. And the NASDAQ also higher by about 0.4% as well. I'm taking a look at my screen actually on some of the sector activity here just to let you know how things are trending going into the lunchtime hour here in New York, at least on the East Coast. We're taking a look at some mixed activity, but more gainers than laggards right now. Financials, technology, real estate are leading the pack. Financials up more than 1% for XLF. And then bringing up the caboose, you also have health, consumer discretionary, consumer staples. Health is actually down by about 0.5% as of this point in time. Health is in focus, as well as some of the auto names, those who are trying to figure out and get a sense of what exactly the Trump administration is going to do tariff front wise and how that could impact their industries. We also heard from J&J here this morning. That's a company we're continuing to track going forward off of earnings. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up at 3 p.m. Eastern Time. You don't want to miss it.